So what is a portfolio? It is a collection of securities in different proportion. If you still remember, in the first part of this chapter, we already talked about individual security. So let's say I have 1000 ringgit to be invested in an individual security. I put all my money in stock A. So we call it as investment in an individual security. What happens if I have 1000 ringgit and I decide to put half of my money in stock A, which is 500 ringgit, RM 500 ringgit, and another 500 ringgit I want to invest in stock B. So the combination of these, we call it as a portfolio because it is a combination of securities in different proportion. Here I have 50% to be invested in stock A and another 50% I would like to invest in stock B. Okay, so hopefully you already have a clear idea what's the difference between individual securities and portfolio. Alright, now suppose an investor has estimates of the expected returns, standard deviations on individual security, as well as the correlation between securities. So you have few stock. So let's say you have stock A, stock B, and stock C. And for each of these stock, you already calculate the expected return. You know its standard deviations, the risk for each individual security, and you already know the correlation, which is the relationship between stock A, B, and C. The question now is, how does the investor choose the best combinations of securities to hold? How do we know what is the best mix for this investment? How many percent should we invest in A and how many percent should we invest in B and stock C? Obviously, an investor would like a portfolio with a high expected return. When it comes to return, we would choose the investment with the highest return. And for risk, we would like to reduce the risk as low as possible. Okay, therefore, to get the investment with the highest return, we will choose portfolio with the highest expected return. And to get the investment with the lowest risk, we probably going to choose the portfolio with lowest standard deviations. Next, we're going to look at the formula on how to determine the expected return for a portfolio. We have a combinations of individual securities in an investment. We would like to know how much return that we expect to get from this portfolio. So this is going to be formula number 6 in your formula sheet. First one, you need to know the percentage of investment in A times with expected return A plus percentage of investment in B plus expected return B. So back to my example before this, I have 1000 ringgit. I put 500 ringgit in stock A and another 500 ringgit in stock B. So percentage of investment, this one I have 50%. For stock B, percentage of investment is also 50%. When I want to determine the expected return for my portfolio, I will take 50% times with expected return for A plus 50% times with expected return for B. So basically, the expected return of a portfolio is just a weighted average of the expected return on the individual securities in the portfolio. You need to know the expected return for each individual stock first. After that, you can calculate the weighted average to be able to find the expected return for a portfolio. Okay, next we move to the variance of a portfolio. We want to measure the risk for our portfolio investment, so we need to calculate the variance. Please be aware that the variance of a portfolio is not a weighted average. You cannot simply take the variance for each individual securities and just find the weighted average based on the percentage of investment here. Variance of portfolio, we have a specific formula. This one, let's number it as formula number 7. Variance for a portfolio, we can determine by taking the percentage of investment in stock A squared times with variance A plus percentage in stock B squared times with variance for stock B plus 2 times percentage in stock A times with percentage of investment in stock B times with covariance of AB, the covariance between stock A and stock B. Then we can find the variance for a portfolio. Next, how to calculate the standard deviations for a portfolio. This one is formula number 8. We just going to find the square root of variance for a portfolio. So the important formula to be memorized is this one, variance of a portfolio. Since it is not a weighted average of the variance of the individual securities, you need to find it using this very specific formula. So why can't we just take the weighted average for each individual securities to find the variance for a portfolio? Why do we need that specific long formula? The reason why is because the variance of a portfolio depends on both the variance of the individual securities, first one, and another one, it also depends on the covariance between two securities. The variance for your portfolio will be determined by the variance of each individual securities that you try to combine in a portfolio, as well as the relationship, the covariance between those two securities. That's why we just cannot simply take up the weighted average for each portfolio. We need that specific formula. For a given variances of the individual securities, a positive relationship between two securities increases the variance of the entire portfolio. If your stocks or your securities are having a positive relationship, there is high possibility that variance for your portfolio will be higher, meaning that your portfolio is riskier. On the other hand, a negative relationship between two securities decreases the variance of the entire portfolio. If you have stocks that are negatively related to each other, your variance or risk for your portfolio is expected to be low. So we can say that this portfolio is having less risk. This concept, we call it as hedging. If one of your securities tends to go up when the other goes down, your two securities are offsetting each other. So remember, before this, in the first part of the video, we already talked about when the stock price for stock A increases, then the stock price for stock B decreases. The loss here, the loss that you need to suffer from the decrease of stock price in B can be offset by this one, the increase in the stock price for stock A. Therefore, when they offset each other, the risk of our entire portfolio will be low. The famous quotes regarding this hedging concept is it's not. That one is referring to diversification. So again, about hedging concept, when we choose to invest in a portfolio, what would work best for us is that choose stocks or securities that are negatively related to each other, with the hope that we can have a lower variance and we can reduce the risk for our entire portfolio. Okay, now let's attempt an illustration on how to calculate expected return and standard deviations of a portfolio. We're still talking about stock A and stock B. We already know the expected return for each individual stock. We know its variance and standard deviations, as well as the covariance and correlation between stock A and stock B. Now, the situation given here is investors would like to invest. These investors has 100 ringgit and would like to invest 60% in stock A. So, if we calculate the percentage of investment A, we have 60%, while for B, 40 ringgit over 100 ringgit, we have percentage of investment of 40%. How to find the expected return? So remember, expected return for a portfolio is the percentage of investment, which is 0.6 in A, times with expected return for stock A, plus percentage of investment in stock B, 0.4, times with expected return for a stock B. So we should get expected return for a portfolio of 0.127 or 12.7%. Okay, next we move to find the variance for a portfolio. So this is the formula to find the variance. Percentage of investment in A squared, 0.6 squared, times with variance A. So here I have the figure for variance 0.066875. So I just take this figure. If let's say you do not have the figure for variance, but you have the figure for standard deviation. So if you use the standard deviation figure here, you need to times with 0.2586 squared, because this one is standard deviation. We need the variance. So this is why we need to square the standard deviation. So either way, depending on the figures that you have. plus percentage of investment in B squared 0.4 squared times with variance B 0.013225 plus 2 times 0.6 plus times with 0.4 times with the covariance for AB. This one, negative 0.004875. So you should get the variance of 0.023851. If the question asks for standard deviation for a portfolio, you need to square root of this variance. So you will get standard deviations of 0.1544 or 15.4%. Alright, before we do some exercise on the calculation for expected return and risk for a portfolio, let's discuss a bit on diversification effects. Okay, so you already know that when you were to find the expected return of a portfolio, what you need to do is just take up the weighted average of it of the expected return on the individual securities. You have expected return for each individual stock. You just times with the percentage of investment for each. Then you get the expected return of a portfolio. This one is very simple. While to find the standard deviations of a portfolio, we cannot simply take up the weighted average of the standard deviations of the individual securities. Why? Because of the diversification effect. So this one here. Diversification means you try to reduce risk by investing in a variety of assets. So remember that when you invest in a portfolio, you try to combine few securities in an investment. So when you diversify your investment, you would reduce the risk. Like if I have 100 ringgit, I put all my 100 ringgit in just one stock, the risk is higher if compared to I have 100 ringgit, 50 ringgit, I put it in stock A and another 50 ringgit, I invest in stock B. Because when I diversify my investment, the risk for my entire portfolio can be reduced. Diversification reduces variability, meaning that our risk can be lowered down. Portfolio diversification works. Why? Because prices of different stocks do not move exactly together. Like if the stock price for stock A increased by 1 ringgit, the stock price of stock B will also increase, but it is not exactly by 1 ringgit. Maybe the stock B price just increased by 50 cents only. This is just a simple example. Generally, stock price changes are less than perfectly correlated. So when you calculate the correlation, there is less possibility to get perfect positive correlation. To get correlation equals to 1. This is almost impossible to get the perfectly correlated stocks in the market. As long as the correlation is less than 1, the risk of the entire portfolio will reduce. So when you want to invest, let's choose the portfolio, or let's choose a combination of stock with a correlation less than 1 so that we can minimize the risk. It is now time to do some exercise. We have two exercises here, exercise 3 and exercise 4. So let's take some time to apply the formula and try to make a suggestion with the justification on the best possible choice of investment as required by each exercise. This is the end of part 2 for chapter 2. I'll see you again in the next video. Bye.